Welcome back to my channel. In this video, I wanted to cover CVS. You likely know who they are because CVS has a very popular network of pharmacies across the United States. They also have some urgent care centers and health services centers where you can go see a nurse practitioner and for common ailments like a cold or a flu. Last, they are a healthcare insurance payer. So they're somewhat of an integrated, diversified healthcare company. And they announced their earnings today. They announced, and the stock market really likes what they're seeing. I'd like to go over the earnings, go over the company, where the stock's traded. I'd like to value the company, compare it to its current stock price, valuing the company based on intrinsic value of its free cash flows, as well as the intrinsic value of future profits. And last, I will look at the desirability of CVS. Is this a highly desirable business or not? And I'll share with you what I intend to do with this stock. I am currently a shareholder of CVS and will decide if I should buy, hold, or sell my shares. Let's get started. The earnings were very good for CVS. They grew 8.4%, and this is a very big company. In fact, in the quarter, they did almost $100 billion of revenue. That's really big. And year-to-date cash flow from operations is really good, much better than I expected, and much better than I had forecasted. So they're actually doing better with regards to cash flow. So that looked really good. What also looked good was that they raised their guidance for the full year, saying, hey, we're going to do better than expected. That's really good to see. When you think about the CVS business, it's a necessity. If we have a prescription to fill, we're going to go to one of their pharmacies. And they provide healthcare services. So again, if we have to go to the doctor, we go to the doctor. And their health insurance it serves a lot of Americans. So overall, it's a good stock for all times, but especially when we're in recession or when we have a big sell-off on growth stocks, you're going to see CVS stand up nice and tall. CBS produces really good cash flow. The reasons for it is in the case of the insurance business, they collect premiums well ahead of when they have to pay for the services that that particular person that's insured needed. And their business, their retail business for pharmaceuticals, is also a really nice cash generating operation. And for the first 6 months, they generated $6.4 billion of cash from operations. They don't have a lot of CapEx. So the CapEx number really takes away 1.3 billion. So it leaves them with more than $5 billion of free cash flow for the first half of the year. I had projected previously that I thought they'd do 7.5 billion or more free cash for the year. So I feel confident they're going to exceed that number. CBS stock has done quite well this year. Year to date's up 38%, and in the pre-market, the stock is up 7%. So it should go up nice and high into the 45% rate of return for the current year. So that's really good. Just in 7 months, it's up quite a bit. And they also pay a nice dividend, by the way. So you get a dividend of more than 4%, and the stock is appreciating. So this one's been a winner in two ways. The other thing I'll point out is that when times get tough with growth stocks, like you saw growth stocks really sell off in the March, April timeframe, this stock really held it together. It did not sell off. So this is a nice hedge on those growth stocks that I own. So I like having it for that reason. And a 38% rate of return before that 7% pop is also a really nice thing to have. CVS is moderately desirable to me. And the reason why it's not highly desirable is it really doesn't have a moat to keep away competitors. It's retail business for pharmacies. It's not unique. Other companies can do it. I happen to think CVS is probably the best at it, but they don't have a moat to keep away competitors or keep them from opening pharmacies and competing against them. Same thing with the health insurance business, as well as their health services business. But they have a lot of attributes that are attractive. Again, the competition, they don't get an A there. I think they get a B because they do operate really well, and they're the biggest one, showing that they do have a big scale advantage. That scale advantage gives them network power. I think the CBS brand is very well recognized, and it's a place where I typically go buy products and get my prescriptions filled. The balance sheet's in decent shape. It's not a perfect balance sheet, but it's in decent shape. I like their revenue growth. For a company that's upwards of $400 billion in revenue to be growing at 8%, I feel is a very, very good metric. Profitability is okay, and their cash flow is terrific. This happens to be a really high cash generating business, so I like that. So I put CBS in the gray, in the zone where their moat isn't overly powerful. It's not like a pharmaceutical company that has a patent on a drug, nobody else can make it. Not quite that strong. So they don't rank very high on strength of moat. But when it comes to revenue growth and free cash flow, they rank quite well. So I put them in the gray. Companies in the gray, I like to invest when I get a substantial, compelling discount. CBS is a $78 billion market cap company, and you're just paying a small fraction of revenue. So the sales price to sales ratio is way less than one. And the P ratio this year is 17. Next year, it'll be 9.65. Price target, analysts think it's discounted by 20%. And they do pay a nice dividend of 4%. When we look at their fundamentals, there's a lot of growth on here. They've just been growing and growing, getting larger. They're knocking on the door of $400 billion of revenue. That looks really good. And we saw that the most recent quarter, they grew at 8%. And historically, look at these cash flow numbers. They were doing 13 billion, 15 billion, 13 billion just a couple of years ago. And if they can return to those levels, this stock is worth far more, because if you do a valuation on a $10 billion free cash flow generating company, that's a pretty good valuable company. Gross margins are really low because they are in pharmacy, healthcare, and that's typical in that industry. But they drive that free cash flow, and that's what this stock's all about. The balance sheet of CVS is a work in progress. It does have a high level of debt, $68 billion, which gives them a debt to EBITDA of 4.5. Now that's improving very quickly as they get their business back on track from some troubled times a couple years ago. That is going to fall below 3 at some point, is my expectation. So for now, I'm willing to accept the balance sheet with a 4.5 debt to EBITDA ratio and invest in the company. The RSI of the company is 46, showing that it's slightly oversold. And with today's price action, it's probably going to go above 50. A lot of investors are going to come into the picture. Their dividend is, I think, safe because their cash flows keep expanding. Their payout ratio right now is 63%, but I think that's a temporary high number. As you see their cash flow really expand, I think they're going to do quite well. I've updated my valuation for CVS, taking into account the most recent financials that they put in their earnings release, and I get a 44% discount on CVS. That's a really nice discount, especially on cash flows. And this is a very conservative cash flow forecast that I have. They could really exceed this. If they get to 10 billion, geez, it really, really rockets up the company. So I expect their cash flows are going to grow, and the business is going to be recognized as just a really nice, valuable, discounted, stable, safe stock that pays a nice dividend. 8 institutional investors own CVS, showing that this stock attracts these big professional investors to invest. None of the big giant names that invest in growth stocks are listed, but these are well-known super investors that invest big amounts. For example, this particular fund has invested $3.3 billion into CBS. I like looking at what institutional investors are doing because it just adds a little more confidence in what this stock is worth and if other investors are buying. Having said that, what am I going to do with CVS? I'm going to buy more shares. I think it's a terrific opportunity to buy a company that's really achieved good recovery from some troubled times, pays a really nice dividend, has terrific upside. I could see the stock continuing to move up in 2025. If we hit troubled times with the stock market selling off, this stock has also showed that it'll keep its value while growth stocks sell off. So I'm going to be buying CVS going forward. Thank you for watching my video. I hope you found my analysis and research on CVS interesting. I wanted to make you aware of a paid member program that gives you added benefits as an investor. I think it could help you grow and learn more as an investor. You can get more details of the programs available on the home screen of my YouTube channel, look for the join button toward the bottom of the screen. When you become a paid member, you get access to member calls, you get access to a Discord where we are active on it every single day. You get access to all my research 24/7 as well as investor tools. So take a look and see if it's something that you would like to do. Thanks again for watching and good luck with your investments.